All right, welcome back to Talk Tickers. So today we are digging into what has to be one of the weirdest earnings reports of the season, and that's Wingstop's Q3. I mean, you look at the headlines, they looked pretty rough, right? But the stock, it just took off. So in this explainer, we're going to figure out what exactly the market saw that most of us probably missed.
So, yeah, let's just get right to the heart of it. I mean, on the surface, this whole quarter looked like a total miss. Revenue was light, and management even cut their sales forecast for the rest of the year. And yet, the stock rallied over 10%. So, why? What is going on here? We're going to break it all down.
Okay, first things first, let's just look at the raw numbers. This is where all that confusion started, because you've got the top line and the bottom line telling two completely different stories.
So check out this split. On one side, you've got revenue missing by 5% and a really significant cut to their same-store sales guidance. That's not good. That's the bad news. But then, on the other side, you have their adjusted earnings per share, and they just absolutely crushed expectations, beating them by over 18%. So what's the big takeaway here? It's simple. Sales are slowing down, yeah, but their profits are just soaring.
And this was the market's reaction to all that, an 11% jump. It's wild. It's like investors weren't just shrugging off the weak sales numbers, they were out there aggressively buying up the stock. So you got to ask, right? The big crucial question is, why?
Okay, so to really get this, we've got to look at Wingstop's business as two separate things right now. Think of it like a car. You've got one part that's kind of dragging, that's the sales, but then you have this incredibly powerful profit engine under the hood that's just humming along, driving the whole thing forward.
And when you put them side by side, the difference is it's stark. The sales drag? Yeah, it's real. No doubt about it. Same-store sales are down because, consumers are feeling the pressure. But then you look at the other side of the equation, the profit engine. I mean, we're talking a record number of new restaurants opening, a massive boost to their margins because wing costs came down, and they kept a really tight lid on corporate spending. In the end, that profit story didn't just win, it totally blew the sales story out of the water.
So you're probably wondering, how on earth can they pull that off? Well, here's the secret sauce. It all comes down to their business model. It's what we call asset light, which is a fancy way of saying it's a highly franchised system. See, Wingstop Corporate doesn't have to fork over a ton of cash to build new stores. Their franchise partners do that. And with those partners opening new spots at a record clip, and each one of those stores pulling in a solid $2.1 million in sales on average, well, that high-margin royalty money just keeps pouring in, even if same-store sales take a temporary hit.
Okay, and that brings us to the future. Because look, the market didn't just pop on this quarter's profits alone. No way. The real reason for that rally was that management laid out a super clear plan for how they're going to get sales growing again next year. They gave us 3 key things to watch.
So here they are. First up, they're doing a huge operational overhaul they're calling the Smart Kitchen. Second, they're launching a brand new national ad campaign to get new people in the door. And third, they're rolling out their first ever loyalty program called Club Wingstop, which is all about getting their huge base of current customers to order more often.
All right, let's talk about this smart kitchen, because this thing could be a total game changer. The big goal here is to slash their service times in half, getting it down to a consistent 10 minutes every time. Now, why does that matter so much? Well, think about it. Suddenly, Wingstop becomes a real option for a quick lunch or a fast weeknight dinner, times when before you probably wouldn't have even thought of them.
And the best part? We've already got proof that this actually works. Down in the Southwest, where they've had the Smart Kitchen running the longest, same-store sales growth is already beating the U.S. average by a solid mid-single-digit number. So this isn't just a theory. The strategy is already delivering real results on the ground. So then you've got the new ad campaign, Wingstop is Here. This one is all about tackling their other big opportunity, just plain old awareness. Management basically said, hey, when people are ordering food for a group to eat at home, we're only getting 2% of that money. But the research shows their fair share should be more like 20%. I mean, that is just a massive, massive runway for growth. It all starts with getting more people to simply know they exist.
All right, so let's tie this all together now. Let's go back to that big question. Why on earth did the market just ignore those kind of ugly sales numbers and send the stock flying up 11%?
Okay, here's the bottom line. The market looked at that sales dip and said, you know what? That's temporary. That's just the economy right now.
The real story, the big bull case for Wingstop, is that durable, long-term growth from all those new restaurants. And when you tack on a really credible plan to get sales moving again, plus a huge international growth story, well, you can start to see why smart investors were more than willing to look past the short-term noise and focus on what's coming a year from now.
Okay, that brings us to our final segment here at Talk Tickers, the next call. We've broken down the quarter, so now it's time for our take on what happens next.
So, our rating on Wingstop is outperform. Simple as that. We think the market got this one right. They saw the real long-term signal through all the short-term noise.
And our thesis is pretty straightforward. That super powerful, high-margin story of opening new stores, it's completely intact. And those strategic catalysts we talked about, the smart kitchen, the new advertising, the loyalty program, they're all credible, and they're all set to really start kicking in next year. That's a powerful combination that we believe is going to re-accelerate growth in 2026.
So what's our prediction? Well, for next quarter, expect more of the same on the sales front. It's probably going to stay a bit weak, just like management said. Because of that, the stock will likely just kind of hang out around these levels, consolidating, as the market waits for real proof that those new initiatives are working. Now, for a plausible trade idea, and this is just an idea, given all the options activity, you could look at something like selling cash-secured puts. That lets you collect some premium now, while setting a price you'd be happy to buy the stock at. Or you could consider a bull call spread if you want to bet on more upside but with limited risk. And of course, remember, this is not financial advice.